Welcome everyone to Best Interest. This is Shane, and in this video we are going to take a look at 3 stocks at or near 52-week lows. But before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you. And for those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, dollar cost averaging into your portfolio on a weekly, bi-weekly, monthly, quarterly, once a year whenever you get your taxes basis, whatever that timeline is, just be consistent with it. And on this channel, we do a dollar cost average approach, right? Buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. Again, I do a dollar cost average approach every week, consistently investing into the stocks within the portfolio. Every time I get paid, I also do a large purchase if I have extra funds, like a bonus or a side job or something like that. I cover all my investments into this portfolio on the channel. I do not have a paid Patreon account. There's nothing to pay for. I don't have any paid walls. I don't have any other sites I'm going to send you to see what my portfolio is doing. I out in the open every week, show my portfolio every Sunday. So if you are interested in that, you could take the time to hit the thumbs up button down below. Hit the subscribe button. Join us on this journey to financial freedom. Make sure you're subscribed to the channel. Join us in the vested interest community. Hit the notification bell so you're notified whenever we put out any new content. And share with anyone you think that might find value in the content. Any investors you know out there, dividend growth investors specifically. And with that said, thank you to everyone who has taken the time to do that. Really do appreciate it. And doing that really does help out a small YouTube channel like mine grow. Helps with the YouTube algorithm to get the videos out. So thank you. Thank you. I do appreciate it. Now let's jump in. First off is CVS Pharmacy. We are talking about CVS Health Corporation, ticker CVS, out of the healthcare sector. They closed out the day on Friday here, and all of these will be as of the close of business on Friday afternoon, the 10th. It is Saturday, May 11th. Closed out the day at $55.82. Looks like they were down a little bit more in the after hours. And their 52-week range here, low of $53.70, a high of $83.25. So definitely right up against their 52-week low, which is why we're looking at them. They have a EPS sitting at $5.70 per share. Price to earnings ratio is low, $9.79 per share. Forward PE is even lower than that at $6.45 per share. Their dividend is $2.66 paid out on the year, divided by 4, though we'll see that here in a little bit, with a very nice starting dividend yield of 4.77%. Ex-dividend date is April 19th. They paid out on May 1st, right? So if you were to buy them now, you would be in line for the next dividend, though you're going to have to wait a few months. A beta of 0.55, so they are less volatile than the overall market, even though they had recently had a very big drop down. Analysts call them a consensus buy right now. Price target of $77.95, so upside of 39.65% potential. Their earnings date was May 1st. Now we're going to jump over to dividend yield theory here, see if they're potentially undervalued. To do that, we look at their 5-year dividend yield average. We compare it to their current 4.77%. Very nice starting dividend yield on this one right now. And it is higher and much higher. That speaks to some undervaluation as well as a very nice margin of safety on this one, at least according to dividend yield theory. Payout ratio is 43.5%, so they have a very safe dividend in my opinion, right? I like 75% or lower. This is very, very low. That gives them a lot of room if they have any issues with upcoming earnings or revenue, if they want to continue to raising that dividend, if they want to make some acquisitions, which they recently have made some acquisitions. So that is going to affect their return on invested capital, return on equity numbers. And overall revenue and profits right now as they pay for some of those acquisitions. You know, it drops that number down, and then they start to see some returns from those investments over the next 2 to 3 years, right? But very low payout ratio here. We're going to jump down, look at return on equity and return on invested capital. I like 10% or better for both of these typically. Return on equity, this one's sitting a little low at 9.8%, though that's close enough where I'd call that good enough. Return on invested capital is a little lower than that 6.0%. Again, I like 10% or better here, but because of the recent acquisitions, I can accept that that is a little lower and then will look forward to the next couple of years for that revenue and profits to return back on that investment. Now we're going to look at free cash flow here. As dividend growth investors, we should want growing free cash flow over time because dividends are paid out of free cash flow, and typically if a company has growing free cash flow, they will have growing dividends to match. Now going back to 2020, you can see here $13.4 billion, up in 2021, $15.7 billion. Now it looks like there's a drop in 2022 down to 13.4, and it looks like a further drop in 2023, which I would say definitely a drop from 2022 to 2023, but not necessarily from 2021 to 2022, because if you look here, the repurchase of capital shares went up. They weren't doing any back here in 2020, nothing in 2021. Huge jump to 3.5 billion in 2022, and another 2 billion in 2023. And with them being down as much as they are, I am sure hopeful that they continue to buy back shares as cheap as they are in 2024. So I would say a bit of a decrease in free cash flow, probably up a little bit from 2021, but down from 2022. Now, continuing on with CVS here, we're going to look at their revenue, and this is what you want to see in revenue. Nice, steady, stair step up. Companies will follow revenue over time. So as long as this company's revenue continues to grow like this, and again, that's nice, steady growth, the company's stock price eventually will follow this revenue growth. Now, profit margins tell a little bit of a different story, right? They are up and down, and you can see here pretty steady through 2019 to 2021, big drop down in 2022, but then back to growth in 2023, and not really down much from where they were at 2021 and 2020 at the height of COVID, which they were probably getting higher than normal profit margins for some of the things that they were doing back then during the CV19 stuff. So overall, pretty good profit margin growth over the last year. Same thing with EBITDA, right? Earnings before interest, tax, deductions, and amortization is what that stands for, right? So this is, again, earnings, and companies will follow earnings over time. So same thing, 2019 2020, nice growth, a bit of a drop from 2020 to 22, and then over the last year, at least from 2022 to 2023, we're currently in 2024, so we'll have to see what that one does. Back to growth, right? And pretty close to where they were at 2023, not much down from where they were in 2020. Again, very nice dividend yield on this one, 4.77%. Annual dividend is $2.66 or 0.66 cents per share per quarter here. Ex-dividend date we saw was April 19th. They paid out May 1st. They are a quarterly payer. Low payout ratio, 46.67%. Dividend growth, very nice at 9.96%. Not quite double digits, but high single digits. Only 2 years of growth on this one, though they've paid a dividend for much longer than that. They just haven't been growing it. They had a pause on their dividend for quite a few years. Buyback yield to 1.86%. And if you're a shareholder, which I am long CVS. I am adding this one right now, of 6.62%. So overall, CVS is actually one of my favorites on this list of 3 here, but let's keep on going. I actually have them in order of how I like them. Cisco being my second favorite right now. We are talking about Cisco Systems, ticker CSCO, number 2 on our list. This is out of the information technology sector. Close out the day on Friday, $48.06. You can see here 52-week range as low as $45.70, as high as $58.19. Again, another one very close to its 52-week low. That's why we're looking at it. EPS sitting at $3.28 per share. Price to earnings PE ratio at $14.65 per share. Forward PE even lower than that at $13.69 per share. Dividend is $1.60 paid out on the year. Divide by 4 because they are a quarterly payer, though we will see that here in the next slide, just like we did with the CVS. Nice starting dividend yield, 3.33%. Ex-dividend date was April 3rd. They paid out April 24th, so again, you wouldn't be in line for the next dividend if you were to buy them now, though you're going to have to wait a couple months. A beta of 0.86, another one less volatile than the overall market. Analysts call it a consensus buy. They have a price target of $55.53, which is presenting a potential 15.54% increase from where it currently sits. Earnings date was May 15th, so they're going to be releasing earnings next week. Now we're going to jump over here to dividend yield theory. Look at their 5-year dividend yield average of 3.3%, or 3.0%, I'm sorry. Their forward annual dividend yield is 3.33%, so another one that, according to dividend yield theory, is potentially undervalued. Payout ratio, much like what we saw with CVS, very low. I like 75% or lower. This is at 47.42%, so again, They just made some recent acquisitions as well. Gives them lots of room to make acquisitions, pay down debt, reinvest back into the company, pay dividends, and that's why we want them to be, low, so that they can continue to increase those dividends over time. And if they happen to have a slow quarter with revenue and earnings over a couple quarters, they have room to absorb that. That's the idea with looking at the payout ratio, making sure not only the dividend is covered now, but it's covered going forward in case the company has any issues. And all companies will have issues over time at some point. Now let's jump down and look at return on invested capital and return on equity. Again, I like 10% or better for these. Return on equity, very high, 30.2%. Return on invested capital, 22.57%. Very good numbers. Even the return on assets, 13.5%. Very good. Let's look at free cash flow. Again, we want growing free cash flow over time because we want growing dividends over time. Going back to 2020, 14.6 billion. 2021, 14.7. Looks like there's a drop in 2022 to 12.7. Right back up again in 2023, 19 billion. So free cash flow growth, as well as, look at this line again, repurchase of capital shares. So even though it looks like there was a drop from 2021 to 2022, see how they jumped that up in the repurchase of shares? They're pulling a lot of shares out of the market. So really there wasn't a drop there. There was a continuation of this increase in free cash flow. They just used some of that free cash flow to buy back shares. They're continuing to do that. I like that they're buying back shares while I feel like it's relatively cheap. This is another one. I'm not going to be adding as much as I have been to CVS because this is a larger position in my portfolio, but this is another one I'm going to be nibbling on as long as it stays here under $50 per share, which is under my cost basis as well. Let's continue on with Cisco. So again, another one, nice steady revenue growth. It flatlines a little bit here, but the last few years, 2021, 2022, 2023, though it's slow, it's seeing revenue growth. Profit margin, it's been pretty steady here in the around 20% range, up and down from year to year. But overall, if you want to say it's down from 2022, you could say that, but still above the 20% range. So nice profit margins. Here's the Cisco EBITDA, right? So they've been growing their earnings before interest, tax, debt, and amortization for the last several years, from 2021, 2022, 2023. Nice growth. Very good numbers overall for Cisco. Dividend yield, excuse me, 3.33%, $1.60, 40 cents per share per quarter. April ex-dividend date was April 3rd. Again, they paid out April 24th. Quarterly payout ratio low, 48.78%. Dividend growth of 2.61%. That's the only downside here with this one. I wish they would increase this dividend. With such a low payout ratio, I wouldn't mind increasing this. I'd like to see at least 5 to 6%, but slow, steady grower. There's worse companies out there that aren't growing their dividend at all. And with a dividend yield of 3.33%, I can deal with the 2.6% growth so long as they're very consistent with that. Again, I'd like them to increase this with such a low payout ratio, but they are doing some other things to help, like paying down debt, buying back shares. So I don't mind that as well. So long as they keep buying back shares, I'm fine with that. 13 years of growth, buyback yield 1.04%, shareholder yield 4.37%. Again, 40 cents per share per quarter. Cisco, number 2 on the list. I am buying CVS. I am nibbling on Cisco right now. And last, this is one I covered this week, actually, in one of the Stock Pick of the Day series. Go ahead and review that video if you'd like. We are talking about Franklin Resources Incorporated, ticker BEN. This is out of the financial sector. Closed out the day on Friday, $23.74. 52-week range as low as $21.81. Again, right up against their 52-week low, as high as $30.32. A beta of 1.45. So this one is more volatile than the overall market, and you can see that volatility just Friday, right? Price to earning, or EPS, $1.75 per share. Price to earnings ratio, $13.57 per share. This is one you should look at price to book because it's a financial company. They are under 1, which says they're potentially undervalued. I should have put that down here, but I'm going to keep the videos the same here. On the Stock Pick of the Day series, I did add the price to book one. So again, go check out that video if you want to see more on this particular company. Dividend, $1.24 per year. So they are quarterly payer, divide by 4. Or we'll see that here in a second. Very high starting dividend yield on this one, 5.22%. Ex-dividend date was March 27th. They paid out on April 12th. So again, you would be in line for the next dividend, though you're going to have to wait a couple months on this one. Beta of 1.45, more volatile than the overall market. Analysts do call it a hold, right? They're saying hold on this one, don't buy this one. Price target $27.33, so slight upside of 15.12%. Earnings day, April 29th. So we're past that. Let's take a look at dividend yield theory. 5-year dividend yield average of 4.32%, currently at 5.22%. That speaks to undervaluation, at least according to dividend yield theory. Now, this payout ratio is under 75% that I like to see, though it is getting up there. Anytime you get above 70%, that's whenever you want to start really watching the payout ratio. 70.52%. Return on equity and return on invested capital, again, I like 10% or better. 7.4% return on equity, a little low for me. Our return on invested capital, 2.86%, a little low as well. Now, looking at free cash flow growth, going back to 2020, you can see here 979 million. 2021 up to 1.1 billion. 2022 up to 1.8. Big drop in 2023 down to 989 million. That's a big drop. That starts to get a little concerning. It is up from 2020, but cut in half from where it was in 2022. They are repurchasing their own shares. Actually have gone up a little bit here in 2023, though I don't think it accounts for the biggest drop here, right? So another one I would be watching free cash flow going forward. Here's their revenue. Now you can see they were declining from 2014 to 2020, jumped up in 2021, and then have been declining ever since. Their profit margins, same thing, decline over the last 3 years. Their EBITDA, same thing, decline over the last 3 years. This is one where I'm a little concerned that maybe they are being impacted by a lot of the new brokerages out there or banks starting to open their own brokerage accounts. You know, you got SoFi out there, you've got Robinhood now, you've got Webull, about a dozen other apps you can get on and invest through. Banks all have their own brokerage accounts, BlackRock, Vanguard. I mean, there's a lot of that's what this is. This is a brokerage account, a brokerage firm where you can invest through. So I'm concerned that they are starting to see a decline in the amount of people that are using them compared to a lot of these other services. Nice starting dividend yield, 5.22%. So you might look at this one with decreasing, profit margins and slight decrease in revenue as more of a yield with some potential upside. Annual dividend, $1.24, 31 cents per share per quarter. Ex-dividend date, March 27th. Again, they paid out in April. Quarterly payout ratio, 70.86%. Dividend growth, 3.39%. So very high dividend yield, but very slow dividend growth, just similar to Cisco, which is what we saw in the previous one. Growth, 44 years, though. Buyback yield being negative, I don't like to see that, negative 5.24%. That means they shouldn't be buying back. They're not getting a very good return on their investment when they're buying back shares, though I love it when companies buy back shares. And shareholder yield is basically flat, negative 0.01%. This is not one that I'm buying right now. This is not one that's on my watch list even. It's not again, if you're looking for a very high yielder that you could treat as a bond, this might be something to look at. But right now, with other opportunities in the market, it's just not one that I'm looking at. Well, that is really it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the 3 companies here. Let me know if you have any other ones that you like better than these. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by and spending some time with me today. Hope you have a great weekend. And don't forget, tomorrow we are putting out our weekly portfolio updates. So make sure you hit that notification bell all the other things, the thumbs up, subscribe to the channel, drop a comment. That really does help me out. And tune back in tomorrow for the portfolio update so you can see what was going on in my portfolio this week. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and kindred money. You should never invest any amount of comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.